Hello friends. Last week in my video, we discussed whether smart money was dumping stocks and would retail be left holding the baby. Well, what we saw ahead of expiry was that the retail exhibited signs of hope and a lot of expectation that market prices would bounce back. That is laid out by the MWPL, which was robust even after the expiry, but not too aggressive and greedy. Now, in this video, I am going to discuss whether the month of March, as the soothsayer told Julius Caesar, Caesar, beware of the Ides of March, Ides of March, beware. And indeed, Julius Caesar was stabbed in the mid of March. Now, is this March going to be a difficult month for retail traders, and why? So don't miss out the last segment of this video, and we dive into the usual format of the video. Now on your screen right now is the weekly market roundup. We see that the broad-based Nifty 50 led the rally from the front, and the bank Nifty brought up the rear. The US dollar index fell a whopping 3.5%, over 3.5%, which was a bullish trigger for emerging markets, including India. Bullion jumped because of a weak dollar. Remember, the dollars are invoicing currency in the international commodity markets. Crude oil fell in spite of a weak dollar because I've been telling you this is a market that's oversupplied. And natural gas prices went up due to supply constraints. Do remember, this is seasonal because gas is the fuel of choice for heating in the winter months. Now, the Indian rupee gained against the dollar, which is again a bullish factor for domestic markets. Coupled with falling oil prices, bulls seem to have imbibed some optimism within them. 10-year benchmark bond yields fell, and that was a cushioning point for banking stocks because they tend to be the biggest investors in sovereign bonds. NSE market capitalization went up by a little under 4%. That tells me that the rally was fairly broad-based. Now, market-wide position limits went up, which is routine post-expiry, and the US market indices were down uniformly. That provided headwinds to our markets. Now, friends, I come to our in-house indicators. I start with MWPL. Don't forget, this is one of my favorite studies. It's a do-it-yourself DIY studies, and there is this video which you can refer to as to how you can plot MWPL yourself. Well, now coming to the weekly MWPL chart. Look at how the MWPL bottomed out at 25.5% post expiry as compared to 25.46 in the prior month, and 24.45 and 23.71 in the months prior to that. So basically, traders, retail traders, were exhibiting optimism, as I told you in the beginning of this video. But the fact that in the week after expiry, MWPL stands at sub or below 30%, which is so unlike compared to the recent months that we have seen, it tells me that they are optimistic but not aggressively optimistic. I update this metric on my social media accounts at the end of every trading session. Do make it a point to connect with me, especially on my Telegram channel. My contact coordinates come at the fag end of this video and in the pinned comment and description below this video. Friends, now the turnover of both the stock and index futures. What we saw was turnover fall. That is not healthy. Now, friends, I come to the advanced decline ratio after the price. This is one of the most leading and indicators. So what it tells you is that the Nifty gained 1.93%, which is one of the highest weekly gains in recent times. And the advanced decline ratio rallied up to 2.59, which means for every 100 losing stocks, there were 259 gaining stocks. Now, this seems to be extreme optimism. Can it sustain? Well, statistical weight of evidence tells me that this cannot sustain. This is thanks to the buying that we saw on Wednesday and Thursday last week, and the advanced decline ratio is the highest that I have seen in a very, very long time on intraday basis. So this advanced decline ratio will come down probably, but as long as it remains above 1, bulls are okay. Now, friends, I come to the prompt month basis. What is basis? The premium or discount prevalent in futures compared to spot. And higher the basis, higher the risk appetite, all other factors remaining constant. Although basis, just like options premium, also erodes over time, especially as it comes towards expiry. Now, what we saw was basis come down. Now, this is something that I had warned you that elevated basis to the extent of 284 and 155 on the Bank Nifty and Nifty 50 respectively would unlikely to hold, and lo and behold, that's precisely what happened. But as long as it does not invert, which means futures do not trade at a discount to cash, we are doing fine. Now, friends, I come to our in-house indicator, the impetus. Now, what we saw last week was both the indices made gains, but was it on high impetus or was it on low impetus? Unfortunately, the impetus reading is lower. That's not exactly good news. That means there was lack of buying momentum. There was no force in buying. Monitor the impetus, please. I update this on my social media accounts every single day. Now, friends, I come to the lift, weight, thrust, drag indicator. You won't find this anywhere on the internet. It stood the test of time for 4 years now. What we are seeing is that the LWTD indicator has gone into positive. It's at positive 0.13 as compared to negative 0.47 last week. What does it tell me? It tells me that, relatively speaking, buying support may be a little more proactive in the week ahead as compared to the prior week, and short covering can also cushion decline. So, this is again a weekly chart. Daily updates are there on my social media account every day. Friends, I now come to the bond market, and what you are seeing is the weekly chart of the Indian 10-year benchmark bond yield. What you saw was a very high intra-week level where the Indian sovereign benchmark bond yield went up to 7.89, not seen for months. Although, of course, it did not sustain at that point, and do remember the 25-week exponential average marked as a blue line is acting as a resistance there. The fact that bond yields are attempting to go higher tells you that the bond markets are not really biting the bait where it comes to believing in the topping out of the coupon rate or interest rate cycle. So I repeat what I said last week. I don't think the last word on rate cuts or rate hikes both have been spoken yet. So I'm keeping the powder dry. I'm not committing any funds to either gilt funds or to the sovereign benchmark bonds. I will update the same on my Telegram channel first, foremost, and always. Now, friends, I come to the Bank Nifty, and what you can see on the daily chart on your screen is that the Bank Nifty is still under pressure because it remains under its month-long moving average, which itself is pointing downwards. It's also below the neckline of unconventional head and shoulder formation that has negative implications, and only a rally past the 49,600, or to be on the safer side, a round figure of 50,000 can get the bulls back into the driver's seat. Take a look at the weekly chart right now. The same head and shoulder formation is plotted as a red color neckline, and what you're seeing is the price made a kind of a dragonfly doji, wherein the open and close are close to each other. That means all the thrashing about in intra-week has resulted in no great shakes. The closing price is very close to the opening price, and there was indecision. Price remains below the 25-week exponential moving average, which is the proxy for a 6-month long holding on cost of an average bull. So the medium-term outlook also remains under a cloud. Do remember, banking and financial sector stocks command a weightage of 34.45% in the Nifty. So this is the biggest heavily weighted sector and a swing sector for the broader markets. Keep a watch on the banking and financial sector stocks. In the week before last, this index was number 10 on the most volatile counters list, it slipped 7 notches to number 17, not just because the bank Nifty volatility went down, but also because individual stock volatility went up. So it's too early to pop out the champagne yet. Now, last week I estimated a range between 49,875 on the upside and 46,800 on the downside, which held perfectly well. In the coming week, I estimate a range between 50,000 and 50 on the upside and 46,950 on the downside. In addition to the ranges that I specified, do also look at daily, weekly, and monthly pivots that I update on our Telegram channel and the tutorial video of how to use these pivot levels. Friends, I now come to the daily chart of the Nifty 50. Here, what you're seeing is a relative outperformance by the Nifty, which rose on 4 out of 5 trading sessions last week. The price remains in a bearish downward sloped channel and also below its month-long moving average, which itself is pointing downwards. So the immediate short-term outlook still remains somewhat nervous. Can that change? Yes, that can. The first and foremost the primary condition for bulls to get back in the driver's seat would be crossing above the 23,250 levels. But an absolute change in trends would be possible only if the previous swing high at 23,800 odd levels are overcome. Now, that's a long shot. Can that really happen? That looks, frankly, a little stretched in the absolute near term. Now, friends, I switch to the weekly chart, and what you are seeing is a downward sloping, descending, and therefore a bearish triangle formation remaining in place. Price is below the triangle support line, and also the 25-week exponential moving average, which doubles up as a 6-month long holding on cost of an average bull. So the medium term outlook still remains shaky, but what you are seeing is the bullish candle is contained in the body of the prior week's bearish candle. That's an inside formation as per the Western Dow theory and marks indecision and or consolidation, which means a sustained trade below 22,150 on a closing basis could open up fresh downsides, and for the upside to gain momentum, like I said, 23,250 is a primary hurdle and 23,800 as a secondary hurdle on the upside. Last week, this index was number 15 on our most volatile counters list. It slipped 3 notches to number 18 thanks to a relatively narrower range, and also the fact that individual stock volatility went up in relative comparison. Now, last week I advocated an estimated range between 22,675 on the upside and 21,575 on the downside, which held perfectly well. In the coming week, I estimate a range between 23,150 on the upside and 21,950 on the downside. Do please take a look at the daily, weekly, monthly pivots and the pivot tutorial video as to how to use pivot points. Now, friends, I come to the last bit of statistical analysis wherein I gauge the retail risk appetite by way of their footprint in the 4 derivative segments in the market. Now, both the index as well as the stock futures saw a decline in turnover contribution. Do remember, futures demand more money by way of span and mark-to-market margins from traders. They are more volatile because the delta is 1. So, a decline in turnover in the futures space tells you that risk appetite went down. Where did the turnover go up? In the index options space, which is the lowest risk and where capital is concerned, the least demanding capital intensive sector. So what it tells you is that the retail bulls were going long, but in the least risky segment. Even in the stock options segment, turnover went down. So that tells me that optimism does exist, but It's very cautious and guarded in nature. This is far from aggressive buying that is required to take the indices to new highs or to a raging bull market. Now, friends, I come to my trading strategy and whether institutions will basically trigger Ides of March kind of price scenario in the markets. Now, why are institutions likely to be important in the month of March? Hey, it's a financial year end. The biggest boys in the game in the Indian stock markets are the mutual funds. It's their financial year end, and depending on what they show as for their trading and investing profits, as well as mark to market notional gains, which will reflect both on their performance and they will also have to declare their net asset value or NAV, which will determine future inflows into their fund houses and their various schemes. So everybody has a vested interest in seeing prices go up in March. That's a bullish trigger. Now that's for institutions. What about the average retail Joe? The average guy is busy balancing his books of accounts before March ending, number one. Number two, both institutional and retail traders are going to be busy filing their last installment of their advance tax on 15th of March. That is, if there is still profits in their books. Now, that usually results in a cash crunch in the banking system, in the stock market, and in business as a whole. So, whether this time the advance tax collections be higher than last time, now this is a data point that everybody, savvy investors, traders, institutions, will be watching with hawk eyes. If advance tax collections in the fourth installment is higher than the commensurate period last year, markets will go up. If it is lower, markets will take it as a sign of lower profits and a little bit of nervousness in the undertone in the sentiments and may take a bearish cue. So much will depend on what happens by 15th March. The data should be out in a few days after 15th of March. So do keep your ears to the ground for approaching hooves of horses and the data points, please. Also, do remember the coming week is shorter by a trading session due to Holi, so volatility is likely to be high. Trade on thin volumes and exposure, keep stop losses and Hacienda hedges or tail risk hedges in place. The tutorial video on what Hacienda hedges are is in the pinned comment below and in the description below this video. Do take a look at it, please. Now, for my trading strategy. Hey, nothing is really going to change. I will continue to basically focus on theta decay in the interest rate sensitive space. I will continue to trade public sector units, both long and short, because of the outsized movements in terms of price activity that they are going to do due to the high MWPL buildup on these counters and therefore emotional and financial commitment on this segment of the market. And where bullion is concerned in the commodity markets, any downsides, any major downsides, if any, going to see institutional buying support. Do remember the biggest buyers of bullion are now the central banks across the world. Where industrial metals are concerned, there has been an upthrust, especially after President Donald Trump has announced tariffs on metals, especially copper, aluminium, etc. So what you're seeing is a price go up due to tariff adjustment. But does it mean the demand has gone up? Hey, no. Industrial metal mining company stock prices are likely to see a limited upside. Where will traders likely to focus in the week ahead? I think power, both generation and distribution, energy companies in the public sector space, defense stocks, public sector banks, public sector logistical space. This is where I expect the market to remain focused around. Let's not forget the all time focal point in the market, banking and financial and interest rate sensitives. Companies that depend on EMIs for sales, companies like NBFCs, banks, heavily debt laden companies, infrastructure companies which require a lot of funding and therefore are interest rate sensitive. If there are any more trading ideas that I need to share with you, I will gladly do so on my Telegram channel and WhatsApp channel. Do make it a point to connect with me there, please. And in the comment segment, do let me know how my videos help you become a better trader and what else I can record to help you trade even better. Before I sign off from this video, friends, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And please share my videos with all your friends and family and social media groups so as to help me reach out to a wider audience. I thank you for your patience in being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Happy Holi in advance. Take care. Bye-bye.